Welcome everyone to tonight's Hookup with Real Estate Masterclass. We're super excited to be here with our special guest, Aaron Fragnito, which we'll introduce in just a minute. So Ken, would you please read the disclaimer?
Yes, certainly. We appreciate you attending the Hookup with Real Estate Masterclass. We are not financial advisors. The content we provide is strictly for educational purposes and not intended as legal, financial, or investment advice. Nor is it a solicitation for funds. Remember, participation in this program is at your own discretion. Real estate markets are subject to change and can be dynamic. Hookup with Real Estate and its representatives are not liable for any outcomes resulting from the information provided or engagements with third-party providers. Seek professional advice before making any real estate or investment decisions. By attending, you consent to this event being recorded and understand that internet security is not absolute.
Thank you. Got to get that legal stuff out. Okay, so our mission is to empower aspiring and early real estate investors with exceptional education, invaluable skills training, and genuine opportunities to invest in real estate while simultaneously sharing strategies that guide you toward success in real estate and away from those costly mistakes like my husband and I made early on, which you can read about in the book, Real Women in Real Estate. It's on Amazon. I can send a copy. As an aside, my husband Ken is a licensed realtor in New Jersey. He's also a real estate investor. He's a veteran and a tile contractor. So if you're in this area or you need a referral, you can find him at kenneth-hook.weichert.com. All right, we are powered by the Legends Equity Group. This is some of the people here. It's leader Alex Lovely, me. This is one of our investments. It's a 30-unit multifamily in Las Vegas. The Legends community has good skills training on school.com/real estate club. So there's a big community there. If you have questions, you can ask questions. And they have a fantastic event called the Legends Breakthrough. And Javier, who is here, is the muse for this one in January. But it's not about real estate, but it's about mindset. And it's absolutely fantastic if you make your way to Las Vegas January 8th through the 10th. You can get there through this link, tinyurl.com/hookup-breakthrough. And core tax deeds. And John Burley is here, also very exciting. So he runs a crowd-funded tax deeds company that delivers passive income. We can't talk about anything about it other than I can set up a three-way meeting with us, or you can look more at invest.coretaxdeeds.com. But it is an affordable way to invest in real estate through the end of this year. I made that change for you, John. And so this is our calendar. We are here in October. I do need to point out that November and December will be on the third Wednesday, not the fourth, to avoid the holidays, and I'll be setting out the 2026 calendar soon. Okay, there are two ways to connect with us. All our replays are on YouTube at Hookup with Real Estate, youtube.com/@hookupwithrealestate. And we have a Facebook group where we make posts and, have community information if you'd like to join, also on LinkedIn. All right. You can take the next step and get more information by booking a strategy call with us where you'll get real guidance, real strategies, and real investment opportunities.
What's the cost of the Las Vegas program?
$495.
Does that include hotels or is the hotels extra?
No, it's extra. It is extra.
Okay, thank you.
All right. 10 quote of the day.
An investment is knowledge,
In
in knowledge pays the best interest. Benjamin Franklin. And now we get to the best part of the meeting. We get to introduce our special guest speaker, Aaron Fragnito. Aaron Fragnito is the co-founder of People's Capital Group. He is a full-time real estate investor with a primary focus on helping accredited investors, family offices, and RIAs, registered investment advisors, preserve their wealth in real estate. He hosts the New Jersey Real Estate Network, the Passive Cash Flow podcast, and was an adjunct professor writing and teaching the course Real Estate Entrepreneurship at Rowan University. Aaron's built an 8-figure real estate portfolio and is a well-known name throughout the New Jersey real estate investment industry. He's completed over 300 real estate transactions and has helped over 100 people build their wealth in real estate. Aaron enjoys speaking at real estate events, helping to educate people about real estate investing. He's been a guest on over 80 podcasts, hosted over 200 episodes, and also presents educational webinars on a consistent basis. He focuses on developing strong relationships with family offices and RIAs, understanding their vision and helping them execute their goals into reality. His real estate highlights are 190 plus rental unit portfolio, closed more than $70 million in real estate transactions. You can reach Aaron at Aaron, Aaron, at peoplescapitalgroup.com. Please help me welcome Aaron Fragnito to share his views on how to build a fund of funds, the smart move real estate investors make.
Let me stop sharing and highlight Aaron. Let me spotlight you.
Thank you, Kenneth. I appreciate it. I appreciate it very much here. Absolutely.
Okay.
You're muted, Aaron.
Thank you, Kenneth. Thank you, Don. Appreciate it. Appreciate it so much. Yeah, I was just saying we actually I got to update my bio there. We just bought another property, just a little one. It's worth a little over 200 doors now. And it didn't I think it's I recounted it the other day. I think it's 110 million or so in volume. So I got to update that bio. But anyway, just trying to move and groove here, make things happen, and always
One
building.
quick question before we get
Sure.
started. We always like to ask our guests how they got started in real estate. Please share how your real estate journey began. We would love to hear it.
Sure, Kenneth, absolutely. Well, I read the Real Estate Bible, Rich Dad, Poor Dad there. So I was graduating college. It was 2009. The market was terrible. I went to a job fair. The only company hiring was Enterprise Rent-A-Car. That was the only company that showed up at the job fair. It was a terrible time to graduate college and majored in entrepreneurship at Rowan University. And but I read Rich Dad Poor Dad. I knew I wanted to own real estate. I had a passion for entrepreneurship. So I ended up moving out to Steamboat Springs, Colorado for 6 months and taught kids how to ski, live with my buddies out there, and continue to read about real estate ownership. I read David Lindahl, Apartment Building Riches. I read Trump University's books, and they all made it look so easy. All you do is raise some money, you find an apartment deal, you put it down, you buy it, you manage it, bada bing, bada boom, you got yourself millions of dollars in assets. So I said, oh, how hard could that be? I made a list. I said, okay, in 10 years, I want to have a net worth of $1 million and a passive income of $100,000. Kind of worked down from that goal. And I said, okay, I need to learn the industry, make connections, earn money. And I said, I'll start with getting my real estate license. So I moved back to New Jersey in spring of 2010, got licensed as a realtor, made about $500 my first 6 months. It was dismal, super tough market. So I was forced to learn short sales and REOs, bank-owned properties, and that forced me to really just meet a lot of investors, go to real estate networking groups. I started speaking there. I started getting some short sale listings and learning how to do short sales, and worked with a negotiating company to negotiate those debts at the bank and so on, and started selling those properties, those short sale deals and REOs to investors that I meet at these networking events. And I would go and speak at these events and every chance I had. And I developed my own networking group called New Jersey Real Estate Network. We now have about 5,000 members in that. We do events all around the state. We also have a webinar. We do masterclasses. We're doing one next week. And so I just, built my network out from there and started raising capital. Bought a six-family with my business partner, Seth Martinez, that I still work with today, who owns the second half of People's Capital Group. He was liquid from selling a medical billing company, so he had something I didn't have. He had money, but I had deals coming in, and he was managing and operating these buildings. So he was good at operations. I was good at sales and marketing and kind of sourcing the deals and public speaking and raising capital. So we teamed up, bought a six-family from a "We Buy Houses" sign. I used to staple to telephone poles, and that really worked back then. And renovated it. We bought it for 220, put like 60,000 into it, leased it up, refinanced our money back out in a year, and the light bulb went off. We said, okay, we can do this. We can recycle cash and buy lots of real estate. And then we ran out of money pretty fast, so we started to raise capital and invite other investors alongside to participate in these buildings, and grew our investor base up from there. We have about 113 investors or so right now, about 83% reinvestment rate with those investors. And recently, I've been more focused on working with family offices and ultra high net worth individuals, and improving our investor base there beyond the local RIAs and so on. And just building a good system in place. We have an in-house property management company that manages our portfolio. And we just try to run a really good shop here, and help people build and preserve their wealth in real estate. We're strictly Jersey focused, vertically integrated, and been doing this about 13 years now. Completed about 280 transactions in New Jersey. So just try to run a good business here and do what we say we're going to do for our investors. And that's the story, Kenneth.
Right.
Thank
Shout
you.
out to New Jersey.
That's right. That's right. Who here is from New Jersey? Is this a big Jersey group?
No.
Originally, I'm from Jersey, originally.
Okay. Okay. Very nice. Very nice. Yeah, about 70% of our investors are from Jersey, just
Kevin's
because
originally from Jersey too.
yeah, yeah, I know you're a Jersey girl, right, Donna?
I am. Ken is
Yeah.
too.
Me too. Yep.
Yeah.
Not a
Yeah.
girl,
Okay.
but yeah.
That's right. It's the land where dreams come true here in Jersey. All right.
That's it.
Oh, good stuff. It's often overlooked by syndicators, right? They go to other areas and more like landlord-friendly states, but we've learned how to navigate the red tape here pretty nicely. And So, so tonight, I'll talk about how and why to create a fund of funds. We actually primarily raise all of our capital in-house. I've raised about $20 million or so in my career. We don't normally team up with fund-to-fund managers, but we're starting to reach out to them now. We've set up a system to help them develop a fund, to raise capital, and make it as easy as possible so that they're not bogged down with the back office or the cost of it. And it's actually a lot more affordable than you'd think. There's companies in place these days that make it much easier, much more affordable to start a fund of funds. And we'll kind of go into what this is, how it compares to a co-GP. Co-GP is kind of the outdated, old-fashioned structure. We'll talk about why that's no longer suggested and frowned on by the SEC. And we'll get into why a fund of funds is actually better, and how this is a good way to start if you are in the business of real estate and know other real estate investors, and kind of a thought leader in your space there with investments and real estate in general. Quick disclaimer here, not a solicitation for funds, tax advice, or legal advice. Donna and Kenneth already had a nice long disclaimer there, so I don't have to go too much into this. Here we work with accredited investors only in our investment opportunities. So, quick piece about us here. Since 2013, we've been helping investors build and preserve their wealth through bespoke real estate investment opportunities located in only northern New Jersey here by repositioning multifamily and mixed-use buildings. But we went over these stats already, 280 transactions, 83% reinvestment rate, 113 investors or so. So we'll talk about tonight, what is a fund of funds? Is a fund of fund manager a fit for you? It's not for everyone. See if it's a fit for you. Kind of go through that criteria, how to raise private capital, People's Capital Group summary, and even our current private offering that we can team up on with fund of fund managers. So People's Capital Group is offering qualified investors an opportunity to learn and create a fund of funds, how to raise private capital, and even an opportunity to invest in a 62-unit Class A fully managed portfolio alongside us here at People's Capital Group and our group of investors. This is actually a 3-building portfolio here constructed in 2024 and 2025. That's
Sorry,
in
Aaron, did you have something you wanted to share yet?
Yeah, you can't see it.
No.
I see it.
Oh, you see it? I don't see it.
Yeah. It shows the 3 buildings.
Oh, maybe because I have them pinned. I don't know. Maybe let me unpin you.
Got to
Oh,
unpin me.
there's 3 buildings behind you. But that's your.
Mine's showing him next to him.
All right, hang on one second. Let me just. Does anyone see?
Yes, I'm seeing it also. I
That's
see
so
the
bizarre.
PowerPoint.
I don't know why I can't. All right. Well, I'll be special.
Maybe it wasn't showing
Let me just pin
it was
you.
just showing the highlight here. Okay. Here, let me do this. Okay. It wasn't showing
Oh, okay.
the other stuff, but you should be able to see now. Okay. So yes, these are the 3 buildings we're buying. These are actually right next to each other. Interesting opportunity here because these are in receivership, meaning the owner fell behind on paying the lender. So the lender hired a professional management company to take control of the assets, lease them up, stabilize them, and now sell them for a discounted price. He's into them for about 22.5 million. We're buying them around 18 million. So we're getting them below replacement costs. They were literally built this year and last year and just are finished getting leased up. So rents are a little bit below market value. There's some vacancies, a small amount of value add, but nice opportunity here to buy these Class A buildings at a discounted price. We'll talk about that towards the end of the presentation there. But let's get into what is a fund of funds. So this is the legal way. Can you see, Donna, what I'm doing here?
Yeah, I can, but maybe you can start with what is a fund, and then you can talk about a fund of funds, because some people might not know.
Okay, well, fund is a pool of capital that buys one or more properties in most basic terms, right? So the idea here, yeah, I have another slide that kind of breaks that down a little more. So, but so basically, when we buy a property, right? So here we'll go back here. So we're creating one entity. Okay, PCG Fund 4 is going to buy these 3 properties. Okay, we're raising about $6 million to buy these assets, and we'll invite investors, accredited investors, to invest in that opportunity. Now, the idea of the fund of funds is you create your own fund. Maybe you're going to raise $500,000 or $1 million, and you're going to invest in our fund. And I have another slide that kind of breaks that down visually, and we'll get into it. Okay. I think that's our next slide. There you go. But let's just kind of first discuss what a fund of funds is. So again, you're creating a smaller fund that's going to feed into our larger fund that's buying, in this case, these 3 assets. Okay. So this is the legal way to raise capital. Okay. Previously to this, what a lot of people would do is something called the co-GP. Okay. Meaning I'm a general partner in an opportunity. I'm going to invite other people. Donna's going to be a general partner alongside me in the opportunity, and Donna's going to go out and raise $1 million, and I'm going to raise $5 million. Together, we'll have $6 million. We'll buy this portfolio. Donna and I will share the GP units in the LLC or the shares in the LLC. The more money Donna raises, the more she gets. Right? That's the old way to do it. The SEC frowns upon that because you're supposed to be doing more than just raising capital to be a general partner in a deal. Now, the way to not violate SEC regulations is to create a side fund or a feeder fund or a fund of funds. So Don would go out and create a separate fund that's going to go raise $1 million, pool that capital together, and then invest that $1 million into our PCG Fund 4 that's going to buy these properties. This does not violate any SEC regulations. A fund of fund is the legal way for current real estate investors to invite their colleagues and their friends and their other real estate investors in their network to invest in real estate alongside them and be compensated legally for providing this opportunity. Fund-to-fund managers earn fees and profit splits. They generally earn 1% of capital raise as an AUM fee, an asset under management fee, assets under management. So if you raise $1 million, you could charge a 1% fee per year. That's $10,000 per year. You can also charge a one-time due diligence fee. So generally, that's about a 2% fee. So if you raise $1 million, you can charge 2% of every dollar that comes into your fund. Okay, on 2% of $1 million is $20,000. So you charge a one-time $20,000 fee. And then you get a split of the profits. So on a $1 million raise, let's say you invest in a deal, you make another $1 million in profits. Your fund invests $1 million. After 5 years, you get back $2 million. Okay, that's $1 million of profit. You could get 10% of that as a fund-to-fund manager. That's another $100,000 on your profit split. So between fees and profit split, you can earn over $150,000 raising $1 million as a fund-to-fund manager. Not do any of the work, not have to source the deal, manage the property, manage the management companies, sign for the debt. All of that is done by the general partner, the main operator. A fund-to-fund manager simply raising the capital, investing the opportunity, and then partaking in the proceeds of the opportunity and charging fees along the way and splitting the profit on the back end. So you limit your risk, no signing for the debt, no hands-on management. Your risk is limited to your investment. Okay, and a lot of times fund-to-fund managers will also invest in their own fund as a limited partner, right? Because your friends and family are going to say, okay, you're raising $1 million. Well, how much skin do you have in the game? It's always good to put 50,000 and 100,000 in yourself. It's good to have skin in the game in your own fund. You know, we invest in our own deals, right? We'll invest $300,000 in this opportunity. We generally invest about 5% of what we're raising. We suggest fund-to-fund managers do the same. It's going to help you be successful in your raise. It's not required, but it's encouraged. So then what about the back office? What about the startup costs? What about the process? So it's all done by a company. We suggest tribevest.com. I'll get into that in another slide. There's also Avestor. There's a number of different groups out there. I can talk to you more about what's a good fit for you. Generally, your first fund, TribeVest, is the best group to go with, the best company to go with. They charge $5,000 to start the fee, start the fund. Okay, one-time startup fee. That's all your legal docs, your bank account, all the requirements to start and resources to get your fund up and running. It takes about 5 business days, about 1 week. You can get your fund up and running. They also charge $2,000 a year for back office support. That's getting the K1s out to investors. That's getting distributions out to your investors. That's the software for investors to sign up and get the updates that you're sending out to them, get the information, do their soft reserves, complete their reserves. All that, all the pieces, if you've ever invested as an LP, you know, like that investor software you sign up, like if you invest with People's Capital Group, you go to peoplescapitalgroup.com, you click, log in on the investor. That brings you to our investor software. We use something called Syndication Pro. It costs us about $4,000 a year just for that software, right? When we have our PPM costs $10,000, $15,000. So our costs are much higher than this. This is a very affordable way to start a fund, and the fund itself pays for these costs, right? You might front this money, but the fund itself is going to reimburse you these costs. Or what a lot of fund-to-fund managers do is they put it on a credit card, then they go out and raise capital, and they pay back that credit card once capital starts coming into the fund, right? So these costs are paid by the fund. Again, it's about $5,000 to start, and then $2,000 a year for that back office support, which is very worth it because we pay much more for this. Now we have larger funds, more complicated things going on, but that's generally a good way to go. TribeVest is the company I'm quoting here with these costs, and there's also Avestor as well. Avestor is better for more experienced fund-to-fund managers starting multiple funds. TribeVest is better for people just doing one-off kind of fund of funds or your first fund of funds. And it's semi-passive, right? Let's be honest. Going out and raising capital is a job. But once the capital is raised and invested, your involvement is quite passive. You're simply forwarding the monthly updates we send out to their fund-to-fund managers. You're forwarding the quarterly financials we send out to our fund-to-fund managers and our investors. Your K1, you're sending it to TribeVest or whoever your fund manager is, your back office, and they're going to dice it up and then send out the K1s to your investors. So it's really, you're just forwarding all the information we're giving you. We're taking care of monthly reports, quarterly financials, annual K1 tax forms, doing all the management, all the underwriting, all the heavy lifting, signing for the debt, and the day-to-day operations of the property. Your task is up front in raising the capital, and we work with our fund-to-fund managers to make that as easy as possible. We'll go over that in another slide with marketing
Aaron,
materials.
there is one question from John Burley. Do fund of funds typically seek diversification amongst multiple funds? John, do you want to answer?
Yeah, you can do that. Absolutely. Sure. You could create a fund to fund that invests in multiple deals, multiple operators, right? That might be a great strategy. Your investors might like that a lot. It does make your PPM a little more complicated. A PPM stands for private placement memorandum. It's the legal document that describes the risks and structure of your investment vehicle. But yeah, absolutely. Absolutely, you could do that. Yeah. Most of the time, the first fund of funds people create is just invested in one opportunity, right? Because you'll get a little pushback from your investors. They'll say, well, okay, you got maybe this one deal you're raising for, but what else are you going to buy? Is your next deal going to be a car wash? Is it going to be, a hotel? So you want to have like parameters. Like, I'm going to invest, in multifamily real estate in northern New Jersey between 50 to 150 units in class A, B, and C properties with value add opportunity. That's our buy box, right? We have very specific buy box, right? So yes, you can create a fund of funds that invests in multiple opportunities and invests in multiple other deals and funds. It does make things a little more complicated, and it might make your capital raising a little more difficult off the bat. Now, if this is like your third or fourth fund of funds and you have a track record and your investors are happy, you could say, listen, I'm going to find 4 deals that fit this buy box. And, from these handful of operators that I know, like, and trust. And, these are the types of deals we're going to buy. Right. But generally, people like to invest in one specific deal. Right. And then you raise 500,000 or $1 million, you invest in one deal, you close it out. Boom. That's your first fund of funds. Right. People want to know exactly what they're investing in. What's the timeline? What's the projected returns? What's the address? What's the operator? What's their track record? It's more simple to explain. Right. And simplicity is what helps you raise money. Complexity is a sales killer. So you want to avoid complexity, especially the first time you're going out and raising capital. But yes, you absolutely can invest in multiple deals. Yeah, multiple funds. Okay,
Thank you.
let's go over. Can everyone see what you could see, right, Donna, the slide here? Okay, excellent, excellent.
Sure.
So, here's the flow chart. Okay, so here at the bottom left, here's you or your LLC. Okay, and your LP investment. Okay, there's the arrow going up. Now, let's say you put a $50,000 investment into your own fund of funds. There in the top left is your fund of funds. You are the general partner, the GP. You raise capital from LPs, limited partners. Fund expenses are paid from the fund, and your fees and your profit split go back to you or your LLC. Right? You can own your piece of the fund through an LLC. You can own your piece of the fund through your name. It doesn't matter because you already get the LLC benefits because your fund itself is an LLC. Okay. And as I said, you don't have to put an LP investment in, but it is suggested. It's going to make it easier for you to raise capital if you have some skin in the game. All right. So that's your fund of funds there. Your LP investment goes in, your fees and your profits come back out to you. Okay. Then your fund of funds here in the top left is going to invest capital over into the top right. In this case, PCG Fund 4 LLC, which is investing in one opportunity. Okay, this is a single purpose entity, an SPE. It's passively owned by PCG investors, other limited partners. fund of funds with People's Capital Group, okay, are invested as well in PCG Fund 4, right? So your fund brings in $1 million. We go and raise $5 million. Boom. Now we have $6 million of PCG Fund 4. And we buy this portfolio of properties. People's Capital Group, PCG, is the managing member of PCG Fund 4. Okay. The net proceeds from PCG Fund 4 go back to your fund. Your piece of the fund, your piece of the proceeds go back to your fund, which then go out to your investors. PCG Fund 4 invests in an operating entity that's going to hold the property, it's going to collect the rent, it's going to hold the debt, it's going to pay the expenses, it's going to distribute the net proceeds on a quarterly basis back to the fund, which then distributes it, PCG Fund 4, which then distributes it out to the LPs and back to the fund of funds. Okay. So the operating entity owns the property, takes on the debt, collects the rent, pays the expenses, distributes the proceeds back to the PCG Fund 4, which goes back to your fund of funds, and then ultimately back to you as well through fees and your profit split. So this is the flow chart. What do you think, Donna? Are you more confused, or is this making sense?
No, I mean, to me, it makes sense. Does anyone else have questions about the fund to fund flow? So, on the bottom left, you and your LLC,
Or your
it's
LLC?
or your LLC, you're raising capital from yourself and others, and then you're investing it into the fund, or is it? Where did the others' capitals come from?
Everyone's capital, your friend's capital, your associate's capital goes right into the fund of funds.
Okay, run the fund of funds. Okay,
Yeah.
so it's just
Yeah.
me on the bottom left, and then the fund of funds come here. Got it.
Yeah. Yeah. So you'll create that fund of funds, and investors will buy shares of that fund of fund, and they will invest directly in it. And that's where the capital is pooled. And then once you get to your fundraise amount, you send one big investment over into PCG Fund 4 LLC. Now let's pause for a second here, because you might think, well, why the heck would my colleagues invest in my fund of funds? Why wouldn't they just directly invest in PCG Fund 4 LLC? Right? I'm going to meet them at Applebee's. I'm going to tell them about this great operator, their track record. They have done 280 deals. They got this great deal. It's in foreclosure. They could buy it at millions of dollars below replacement cost. They just finished building it. Rents are below market value. They have this in-house management company. They're going to increase the rents, increase the revenue, sell 3 years later. They've done this many times before. They have hundreds of satisfied investors. Your buddy's going to be like, all right, I'm just going to go to peoplescapitalgroup.com and invest with them. Be like, no. And here's why. Because you're going to get the better share class. See, we have two different share classes. We have a $50,000 minimum investment. That's the lower share class. That's a 7% preferred rate of return. Okay, it's a 70-30 split thereafter. It's the less attractive share class. So if your buddy you met at Applebee's wants to invest $50,000 or $100,000 or anything less than $1 million, he's going to be in the lower share class. He goes directly into our fund. Okay. So you say to your buddy, nay, my friend, don't go to peoplescapitalgroup.com aside from doing your own due diligence. Invest in my fund, because what I'm going to do, I'm pooling together $1 million, and I'm going to get into that better share class in PCG Fund 4. And the better share class pays an 8% preferred rate of return. It pays an 80-20 split thereafter. It targets a 19% IRR, where the lesser share class, the one you would normally get into if you just invested 50 grand directly in People's Capital Group, you get a 17 IRR. So with me, you get a better share class. And even with my fees and even with my profit split, you're still going to come out ahead. Okay. And it's another set of eyes on the due diligence. You're going to underwrite our deal just like we're underwriting. Now, we're going to make it very simple for you. We're going to give you a whole deal folder that you can dig into, a due diligence folder, an in-depth Excel model that's done by institutional level underwriters that passes the smell test for family offices and multi-billion dollar institutions. You get to underwrite that. You get to go through all the data we send you. You're going to underwrite this deal in depth. And that's the promise you make to your investors. It's another set of eyes on the deal. You can underwrite our past performance, right? So not only do your investors get into the better share class, but they get another set of eyes underwriting the opportunity and watching out for their best interests, trying to identify red flags, trying to find out if these operators are what they say they are. And that's the benefit of people investing in your fund. They're going to get in that better share class. They're going to have additional level of underwriting. So that is what you want to be explaining to your colleagues. And by the way, people invest in people they know, like, and trust. I think our next slide goes into that. So, it's important that you understand the capital raising strategy is all about having those relationships in place. That for me would take years to build. The idea of a fund of funds is we're taking advantage of those relationships that you have for years. And those individuals that want to get into real estate but haven't been able to take the plunge, they don't have the confidence, the time, and the resources necessarily to do what we do in real estate. But you can underwrite the deals, you can get them in the better share class, and you can limit their risk and bring them good, well-vetted investment opportunities.
Now, is that typical of normal fund of funds, or is that unique to People's Capital fund of funds where you're giving out better share classes?
No, that's typical. Yeah, most every fund of funds is going to expect a specific, more attractive share class for them. The $1 million minimum investment is for family offices and for fund of funds. So that's it. We create a better share class for a larger check. You should be rewarded for a larger investment. We obviously appreciate $1 million investment more than we do a $50,000 investment. Now, we have many investors that invest $50,000, $150,000, and we appreciate them. They've helped us get to where we are, and we continue to work with them and give them great opportunities. But we love our $1 million family offices and our fund of funds too. My mom used to say, which child do you love the most? And she'd say, well, which finger would have hurt the most to get cut off? And I'd always say, well, obviously your pinky would hurt the least. So which one's the pinky child? And she'd never answer me. So, but you can fill in the gaps there, Donna. You have your pinky investors, and then you have your middle finger investors, your thumb, and I don't know, which finger would hurt the most? Pointer finger, maybe, So that's how investors work. Okay. How to create a fund of funds. So step one, create a fund. Work with a company such as TribeVest, VEST, right there, TribeVest. We think they're the best if you're creating one fund of funds. If you are creating multiple fund of funds, you could work with Avestor. They're $20,000 start, but then you can create multiple fund of funds right under them for free. So, but that I would suggest that like on your third or fourth fund of fund. Like if you're just doing one, start with one. Don't bite off more than you could chew. Go to TribeVest for $5,000. You can start a fund of funds. That's a reasonable cost. The first $50,000 investment you get, you can pay back that $5,000. Again, a lot of fund managers put it on a credit card, and therefore it's really no money out of pocket. You're going to pay that back. Get business credit as well. Step two, marketing material. So we try to make this really easy. We have professionally made marketing material for all of our investment opportunities. So we send you, or we can do it for you. You can send us your logo, send us your company description, send us your headshot, your bio. We'll copy and paste it all in our marketing materials. And we pay about $2,500 for a professionally made deck. Okay, there's an offering memorandum. It's about a 50-page document that goes through all the details of the investment opportunity, our past performance, and so on. And there's a section of it, right, that has our logo, has our company bio, and so on, has our personal, Seth and I, our bios, and so on. We'll keep that in there, but we'll also add slides or pages for your company bio, your personal bio, your headshot. Right? We'll take out our logo, put in your logo. All right, so you could do it yourself, too. We could send you the marketing materials in editable form. It's a PowerPoint slide. You can copy and paste in your logos and make it your own. So we make it as easy as possible for you to get the marketing materials. That includes a pitch deck that's professionally made, costs us $2,500. You get it for free, and a 2-page or 1-page teaser, kind of like a summary. That's a good way to start, right? You don't want to start by sending someone a 50-page deck. start by sending them a one-page summary and get their interest. Give them a little teaser. And that's the best way to raise capital and start the conversation. And then, of course, the additional information like the deal room, the due diligence, the landing page that investors can go to do their due diligence, and so on. Fundraise. So then at that point, now you have the marketing materials. Okay. We offer, promotional, like videos and things like that, like webinars. We'll do a specific webinar just for your group. Reach out to accredited investors in your network. Okay. C-suite executives, business owners, anyone that makes $200,000 or more per year or has a net worth of $1 million, not including their primary residence, is an accredited investor. $200,000 a year net income, or $300,000 including your spouse, or $1 million net worth, not including your primary residence. Okay, that's an accredited investor. Okay, we only work with accredited investors. We operate 506Cs. We do have a 506B that can accept non-accredited, sophisticated investors, but we focus on primarily accredited investors. So those are the types of people you want to be connecting with. Okay, basically high net worth individuals. Show them your success investing in real estate. If you don't have any, show them our success investing in real estate. Determine if they're a fit to invest in your fund. Build that relationship, build a rapport, answer their questions, handle objections. We can even do one-on-one calls with them or group Zoom meetings for your individual investors as well. We prefer you get 8 to 10 investors together, and we do a webinar just for your investors. That's the best way to raise capital together. Step 4, close. Okay, meet with qualified investors one-on-one. Let's take some hand-holding. Answer their objections. We can work with you on that. We do weekly coaching calls. It's all free. Determine if they are fit. If so, guide them in the investment process into your fund and achieve your target capital raise. Most fund of funds, I would try to start $1 million. If we can't get to $2 million, try to get to $500,000. We generally, for the better share class, the minimum investment is $1 million. You come to us and say, hey, you know what? I'm trying to raise for $1 million. I know you're closing soon. I was able to raise $750,000. We'll work with you, right? We want to work with fund-to-fund managers on a long-term basis. We want you to get into that better share class so we can stretch. We can make exceptions. The important thing is you're raising capital. You're getting close as possible to that $1 million number. It might sound like a lot, but you'd be surprised. Make a list. All the people in your network that you feel are accredited investors. Then make a list of people they know. Go through your social media. Okay, just start writing down names, numbers, emails, people in your network. All right, and start picking up the phone, reaching out to them, explaining what you're doing. Do your due diligence. Study the opportunity. Schedule a call with us and our team. Learn about the opportunity. Learn about raising capital. Make a list of those individuals. Get out there and make it happen. That's how you raise capital. Invest and communicate. So step 5, invest in PCG's current opportunity with your fund of funds. Forward PCG supplied monthly updates, our quarterly financials to your investors. We take care of all that. You just simply forward them out to your investors. You can put your logo on top of it and boom, forward it out. Submit your annual fund-to-fund K1 forms to your CPA or your TribeVest. We'll send them the K1 forms, then TribeVest cuts them up for your appropriate investors. So your investors get that K1 tax form at the end of the year. Distribute proceeds using TribeVest platform. Again, TribeVest is going to help you distribute out these proceeds to your investors in the appropriate manner to make sure they're getting paid the right amount. So your TribeVest is going to work closely with you to operate that fund, do that back office, and get all the required tax documents to them and distributions to them as well. Question here. I'm wondering if there's a standard definition for Class A, Class B, and Class C investors. Additionally, do most investors generally understand the distinctions between these classifications? So we try to keep it pretty simple. We just have, Class A is the managing members. That's Seth and I here at People's Capital Group. So Class A is People's Capital Group. That's it. Voting members. Class B is generally the smaller share class, $50,000 minimum investment with the less attractive terms, the lower pref rate, the less attractive waterfall. Class C is generally the larger investment, $1 million minimum investment with the better pref rate and the more attractive waterfall. Um, Investors should understand the difference between these two classifications. It's pretty straightforward to explain. I mean, ideally, I just did in 30 seconds, right? And that's something you would want to be able to do as a fund-to-fund manager. Hey, if you directly invest with People's Capital Group, yeah, you can do that. You can get on these opportunities. But you're going to be in a less attractive share class. What does that mean? Oh, it means a lower preferred rate of return and a less attractive waterfall split. So instead of earning a 19 IRR in the better share class, you'll be stuck in the share class around 17 IRR. So if you want to earn a higher return on investment, you can invest in my fund of funds. We can get into that better share class together. So that's par raising capital. You have to be able to explain the basics of that share class.
John, you have
follow-up.
another question? Go ahead.
Yes, I got a follow-up question to that. In my current fund, which is a Reg CF, we have the management entity as the Class B investors. And then the Class A passive is the passive. So is there any standard? I mean, I think it's just opposite from what you just described. The Class A in your case is the operator, and Class B. So there's no really differentiator in the industry. The A is the management, B is the passive. Like we don't have it set. We have Class A as the passive, if that, or the LP.
Yeah, yeah. I mean, it really doesn't matter. You can call the classes whatever you want. You know, you can call them, whatever you want. Yeah. We just figure Class A, you know, it's kind of the manager. It seems like, the managing member class, right? So Class B. But I like what you did, John. Sell the sizzle, not the steak. Hey, if you invest in John's fund, you get to be in the Class A. Sounds nice.
Thanks for
Yeah.
going over that. Yeah, appreciate it.
Sure, sure. Yeah, we have people say, well, wouldn't Class B be better than Class C because B is before C? I was like, I don't know. I was thinking Mercedes when I made these classes. Like if you want a C class Mercedes, that's nicer than the A class, right? Or Beamer. So that was my basis. But it doesn't matter at all. It doesn't. You can call it kangaroo class, it doesn't matter. It's just however your PPM is drafted. Okay. So, are you a good fit for a fund manager? Right? Is this a good fit for you? Do you currently invest passively in real estate or even actively? Right? Do you currently have experience in real estate? Can you explain it well? Have you had a number of full cycle investments? Have you made money in real estate? Can you say, yeah, I've invested in real estate and I've exited nicely. I've made money investing in real estate. I'm successfully investing in real estate. Do you want to invest alongside me in exclusive opportunities that no one else knows about, right? These deals aren't set on the market. We get these directly from the receiverships, directly from the lenders. These are off-market deals, and now you have access to them. Your buddies aren't going to know about these things. These aren't sitting on LoopNet.com or CoStar. They're not blasted out to 10,000 buyers from Coldwell Banker. These are off-market deals. And you can get access to these. Do you network with high net worth individuals, people in the medical space, tech space, C-suite executives, people earning $200,000 a year or more? Quite frankly, in northern New Jersey, even $200,000 is tough. I know a lot of people that earn $200,000 and have trouble paying their bills. It's crazy, northern New Jersey, right? So you really want individuals around $400,000 to $600,000 income to ideally be able to write a check for $100,000, $150,000 to your fund. Do you have an entrepreneurial mindset? Right? It takes some hustle, some grind to do this. You got to pick up the phone, draft some emails, do your own webinar, podcast, get out to some networking events, hit the pavement. You can't be afraid to ask for capital if you're a capital raiser. A closed mouth doesn't get fed. Entrepreneurs who work hard and ask for the sale are successful in what they do. So it does take some work up front to raise money. It takes some planning, some execution. But once the capital is raised and the investment is made, then after that, you kind of sit back and just forward emails and financials and K1s to TribeVest. So pretty straightforward. And then once the money is raised and you're successful in your investment, the next dollar raised from that client is like a phone call. right? We have a lot of investors. It's 83% reinvestment rate because we do what we say we're going to do. We perform to our investors. We update them monthly with in-depth monthly updates, quarterly financials, right? We have a whole system in place. We're very transparent and we perform for our investors. And guess what? When we have a new investment opportunity, it's one phone call. Hey, Robert, new deal. All right, what are the return? Okay, when you need the money? Okay, boom. 20-minute phone call. Hey, how you doing? Half of it's about our kids, our lives. Oh, by the way, here's our next deal. You're liquid. Okay, great. How much do you want to do? 50. All right, I'll put you down for 50. Go on the website, fill out the docs by Friday. All right, we need the money next Tuesday. Okay, thanks. Have a good day. It's once you have the relationship in place, you're successfully performing for them. The next capital raise is very simple. It's very straightforward. As long as you're doing what you said you were going to do and you have good communication, you have a satisfied client. Most of the time, people are going to keep investing with you in the future. So, do you have colleagues asking about your real estate investments? Right? Hey, Donna, how are you doing with that real estate? What are you doing something in Las Vegas? What's that like? How do you manage something in Las Vegas? How'd you get into that? How do you afford to buy a 30 unit? Isn't it a pain in the neck? Right? Whatever the questions are, right? People are curious about real estate. Everyone knows what real estate is. I mean, it's the largest asset class that we hold our wealth in. Most people's wealth, about 60% of it is tied up in real estate. Billionaires hold 60% of their wealth in real estate. Even more than that, I've read some statistics because of the tax benefits primarily and the stability of it. So it's a very popular asset class. A lot of people are curious about it. Most people tie up their investments in mutual funds, going up and down in the stock market, not really sure what it's invested in, nothing tangible, but you can help them get into tangible real estate. Do you have authority or thought leadership in your network, right? Do people come to you asking advice on all types of things, right? Raising kids, business, investment, right? It doesn't have to be investment. Just are you in a thought leader position in your network, right? And do people know that you're successful in your business and your ventures and your investing, and they're going to be interested in what you have to say. Do you own a business, right? If you're successful in business, generally people are going to be curious about what you're investing in, what you're doing with your wealth. And finally, do you have capital to invest alongside your LPs? Again, having some skin in the game, even if it's just, $30,000, $50,000, having some money in the deal shows you put your money where your mouth is and you're serious about this. And you are also sharing the risk with your investors. It's going to help you raise money. Okay. How to successfully raise capital. So, first of all, it's about know, like, and trust. Right? Make a list of high net worth individuals in your network who know, like, and trust you. That's your A list. Your B list is make a second list of high net worth individuals who are simply in your network. You might not really have a relationship with them. Maybe they're a friend of a friend, or you see them at your kid's daycare every Friday afternoon or something, or a distant family member you kind of see every now and then, but they're loaded. So that's the idea, right? So you have your A list, people you know right off the top of your head. You're probably thinking about them right now, who you could pick up the phone and call. They're going to say, "Oh, Donna, how the heck are you? Great to hear from you." And just they're going to be happy to hear from you, right? And they're going to be able to talk to you. And then you have your B list, right? It's going to maybe take a little more rapport building, but start with the A list and work your way down to the B list. Approach, right, with a plan. Before you pick up the phone, right, I would make the list first, right, to determine whether this is even something you want to do and have the resources to do it. But then approach with the plan. All right, set up a call with our team, know your numbers, know your timeline, know the risks of the investments, know the plan A, B, and C, the exit plan. Well, if they don't sell by year 3, they're going to refinance, right? Here's why they'll be able to refinance. Here's the plan to sell. Here's the type of returns we expect to make on the sale. Here's the type of cash flow you expect to get from the deal. Your investment is limited to your risk. You're not signing for the debt. Your risk is limited to your investment. You're not signing for the debt. You can't lose your shirt in your house here. The GPs are signing for the debt. You're simply investing alongside a number of other, LPs. It's a 3-year investment. We plan to sell at the end of year 3, where you get the majority of returns. tend to get 5% cash flow that's distributed on a quarterly basis, 5% annual cash flow, starts quarter one, right? Why are we buying? Well, it's a discounted Class A building that was just finished that we can get for a discounted price. It would literally cost us more money to build this thing right now. We're buying it for pennies on the dollar compared to what it would cost to build it, and it was built this year. How are we buying it? Because we've been doing this 13 years, completed 280 transactions. We get in these deals before anyone else does. We know the brokers, the owners, the landlords, the receivership companies, the lenders. We get these deals off market for a discounted price. When are we buying? Well, we're closing over the next 90 days. We're collecting capital over the next 30 days. There's a limited time you can invest. Once the fund is full, the opportunity is no longer available. And by the way, scarcity is a driver of sales. If you tell someone, you can invest now, you can invest later, it doesn't really matter, then they're never going to invest, right? Think about when you buy anything, right? Why do you usually buy anything? Because it won't be available tomorrow. The discount is today. The sale is ending on Friday. Whatever it is, the psychology of sales is that there has to be scarcity. So when we raise capital, we have a limited window where the investors can invest, generally 30 days. And you have to have a limited window. If they don't get in, that's fine. They'll get in on the next one. And guess what? If they don't get in on this one, but they wanted to, and then they missed the boat, the next one you do, they're going to be ready. They're going to be lined up, ready to go, right? And those are the best investors that missed the last one. We love those investors because they're ready to go. The best thing you can tell an investor is, sorry, we're filled up. I told you that we had to close out your investment by Friday. You didn't pick up your phone for 2 weeks. We're fully funded. I'll see if a spot opens up, but for now, we're fully funded. I'll let you know as soon as we do the next one. We got to move quick. Got to move more quickly next time. I appreciate your interest. Where's the deal? Well, it's in Ironbound, Newark, one of the hottest markets in North Jersey, up and coming, very hot little area, good place to go out and get dinner. We see a lot of opportunity in Newark. So great infrastructure, kind of a thriving city there. We've done very well in Newark. Okay, so know the why, how, when, where. Follow-up, have a professional, easy to understand yet detailed marketing materials, right? Your marketing materials, know your client, know your customer, right? Don't have crazy in-depth marketing materials, right? Now we do raise capital from family offices and fund, institutional groups and so on, but we have different marketing materials generally for our accredited investors, our high net worth individuals. These are doctors, lawyers, C-suite executives. They're not really in real estate, and that's why they come to us. That's why they need us to invest in real estate. So make your materials easy to understand, yet detailed enough that they can get the information they need and show that you understand the opportunity, right? You don't want to make a hokey pokey kindergarten easy, but make it somewhere in the middle. So that's easy to understand. Complexity is a sales killer. If someone doesn't understand something, they won't invest in it. Don't go into the nitty gritty detail. Try to explain these complicated things in simple, what's the preferred rate of return? Well, it means the investors get paid first before, the operators do. It means the investors have to achieve a certain return on investment. And then once that return is achieved, the waterfall split is distributed out according to the split. The split is 70-30, 70% to the investors, 30% to the general partners. So once we achieve that initial hurdle, then we split up the proceeds 70-30. That's it, right? Don't get into the compounding effects of preferred rates of return. I mean, we do have a compounding preferred rate of return, but that's extremely complicated to explain and understand, right? And as soon as you start getting into it, even though it's like great, right? Compounding effects are great for LPs. Like if they really understood, they'd be like, this is freaking phenomenal. But don't start explaining how preferred rate of returns are compounding, right? Unless you're dealing with like a really savvy financial investor who like has to know that and wants to like dig in on that, right? Just explain 30,000 foot, view of these opportunities, and answer questions directly and honestly, always, but don't over talk the sale. Never talk past a sale. Once someone agrees to invest, stop talking. Start explaining the next steps. Okay? I'm going to send you a link. Fill out a basic form. Complete the eDocs in a few minutes. You get accredited. and then you'll be invested in a few minutes. We'll send you the wire instructions once you fill out the form. The deadline is next Friday. Do you have any other questions for me? All right, great. All right, let's pay the bill and get out of here. Never talk
Speaking
past
of
the system.
questions, if you have your own fund of fund, do you have to go through and verify the accreditation of the people investing in your fund?
Yes, TriVest will take care of that for you.
Okay.
So you're going to have an account set up at TriVest. You're going to have a link you send them. They click the link. They go onto your website, which is really TriVest, creates like a little sub site for you. And then they're going to get accredited right through TriVest.
Okay. Thank you.
Yep. So they're going to support you in that process. Follow up consistently until you get a yes or no, right? It's all about follow up, follow up, follow up, follow up. If you fill out our forms, you download our ebook, you're going to get a call from Patrick. He's a nice young man with an English accent. Patrick's going to call you about once a week. He's going to text you about once a week. You're going to get about 2 emails a week from us. You're going to know we're there. We follow up with you consistently until we get a yes or a no. Right? No answer does not mean a no. A no means a no. And a lot of times people will follow you for a long time. They won't pick up the phone for 6 months. Then one day they pick up the phone. You're like, all right, I'm liquid. I'm ready to go. I've been following you guys. I know, like, and trust you. I understand what you do. We just had an investor do that actually the other day. She put a soft reserve in for $1 million. Been following us for 3 years. We've literally been calling her every 3 weeks for like 3 years. She finally picked up the phone. We talked to her a few times, but so that's how it works. PCG's Fund to Fund Blueprint. Easily edible marketing materials. Our professional offer memorandum costs us $2,500. We'll edit it with your logo, your bio, and so on for free. Send it back to you. 1-page summary. Again, we'll edit it with your logo, your bio, and so on. That's a simple like starter teaser thing you're going to send investors. Simple to understand summary. The due diligence room. We complete a nice, organized due diligence room. You could dig into this thing all day long. Leases, invoices, legal documents, underwriting models that are institutionally created. They're extremely in-depth. We just spoke to a lender. He said, your underwriting models are so in-depth and so they're overly complicated. Can you dumb them down? We said we can, but we have so many variables that so many floating things in these underwriting that we want to be able to have as accurate an underwriting as possible. He says it's one of the most in-depth underwriting we've seen. And they're a lender. They underwrite hundreds, thousands of deals. Webinar as well. We'll create a webinar. You can send that webinar out to your group. We could do a webinar for your group as well. We want you to get at least 8 to 10 people together. We'll do a webinar just for your group then. Weekly coaching, right? Every single week, we'll do an hour-long Zoom meeting with other fund managers. A lot of us are going to be having the same challenges, right? This guy said he was going to invest. He hasn't picked up the phone in 2 weeks. A lot of people I'm talking to are just saying, well, they don't have the money right now. A lot of the people I'm talking to are just saying, well, they want to see me do this first one and then they'll invest on the next one, right? How do we get over these objections? So we'll talk with you, we'll work with you on this. And a lot of us are going to be having the same challenges. I've been raising money about 13 years, I've raised about $20 million. So probably most of the objections you're going to hear, I've already heard and tried to work through. Fund to Fund Manager Profit Calculator. If you want our profit calculator, email me at aaron@peoplescapitalgroup.com. That's AARON@peoplescapitalgroup.com. You can play around with our calculator. Say, okay, how much am I going to make if I raise 500,000? How much would I make if I raised $1 million? How much would I make if I raised $2 million? How much should I make if I increase my AUM fee to 1.5% instead of 1%? Right? So you can fool around with that. Generally, if you stick with industry standard fees and profit splits, $1 million raise is going to equal approximately $150,000 profit for you as a manager. That does not include your LP investment. Right? If you invest money yourself and make money on that investment, that would be in addition to that. That's just on the GP side. Support from TriVest. Okay, then startup support, launch in 5 days. Back office support, including K1s, onboarding, banking, offering docs, ongoing client services, dissolution, the accreditation services for the investor, everything from A to Z. They take care of all of it. We pay a lot more than that for this. And their fees, by the way, are going to be paid out of your fund. Fundraise guidance. TriVest has a lot of videos about fundraising. We're going to guide you in fundraising. Distribution and bookkeeping services, again, that's done from TribeVest. Consistent communication. All right, we're going to send you monthly reports, quarterly financials, distributions, annual K-1 tax forms. Yep. Did you have a question? Okay. All right, we're going to dip into people's capital group here. We'll finish up here real quick and get everyone to dinner here. So this is a property on Marion Street in Paterson, New Jersey. It's one of our properties there. So we're talking about Fund 4 tonight. One of the things we focus on is alpha generation. So we operate within an underserved part of the multifamily New Jersey space here. That's too small for larger investment groups, but large enough for our funds. So we buy between 50 to 150 unit buildings and portfolios. Generally, institutional groups want to be larger than 150. Generally, mom and pop investors are not buying up to 50 units. So we kind of take advantage of that middle point in the market where we're not bidding against institutional groups, but we're also not bidding against small mom and pop landlords either. Skilled deal sourcing. So we talked about that, brokers, attorneys, wholesalers, developers, owners. We get unique access to off-market deals. We never buy anything sitting on the MLS. We rarely buy anything that's even marketed out to other buyers. We're generally one of two buyers in the room. We're not getting into bidding wars or things like that. I mean, there are times there'll be other bids on the table, but we're generally looking at like 1 to 3 other buyers on the table, not like 15 other bids. We're vertically integrated in-house property management company. We've been doing this over 13 years, and so we have a lot of skilled boots on the ground, service providers, contractors, and so on to stay on budget and on schedule. Investor first approach. Our deals are executed with our capital partners top of mind. We only run due diligence and extensive due diligence on deals that produce generally high teen IRRs and consistent cash flow to investors and provide maximum transparency to our investors. Our average rent roll increase per year is about 8.6%. Here's our past performance. Average annualized cash and cash returns, a little over 15%. 12 completed syndications, 83% reinvestment rate from our investors. Here's our team. That's me on the left. I primarily focus on capital raising. There's our deal analysis, Matt Ciancini, expert underwriter, very sharp underwriter, our marketing team. There's Seth Martinez on the right. He's on the operations side. He makes sure the trains run on time. He's managing our property management company. Lena Delgado is extremely skilled. She's managing our contractors, our leasing team, and so on. Then we have our more financial end of it. Dana gets the checks out on time. The ACH deposits right to your account. And our CPA, Robert Grulich. And then we have about 20 different construction contractors we work with as well. Here's our long-term plan. We are working on refinancing 1 or 2 assets this year. We plan to raise about $10 million this year and close on 1 to 2 buildings. 2026, we're going to be targeting about $25 million raise, about $50 million in assets, sell or refinance another 1 or 2 buildings. $50 million raise for 27, look to get about 100 million assets, and then 28 and 30 we'll start harvesting those assets and having nice liquidity events to our investors. Here's the portfolio. They're right next to each other on Mulberry Street and Emmett Street in Newark, New Jersey. This is in South Ironbound section. There's restaurants and stores around here as well. Mulberry Street's a nice, attractive street up that goes up through downtown Newark here. These buildings were built in 2024 and 2025. We're buying them below replacement cost. If you don't know about Newark, New Jersey, it is compared to kind of the next Jersey City, as they say. You ever hear that, Donna? Newark, New Jersey's the next Jersey City?
I haven't heard that one.
Well, you heard it now, my friend. You heard it now. So that's it. Jersey City is just boomed in the last decade.
Yeah.
Newark has a lot of that infrastructure. It has the $1 billion triangle here, the Prudential Center. That's where the New Jersey Devils play, a professional hockey team, 18,000 seat stadium. I just took my son there for a hockey game a few months ago. It was a nice time. The Sports Illustrated Stadium. The World Cup is doing games there. Red Bull Arena. That's where the Red Bull soccer team plays. That's right across the river in Harrison, New Jersey. A lot of development there. Harrison's a hot market.
I used to work at Blue Cross Blue Shield down there,
Okay.
by the train station. Yeah.
Yep. Yeah, I mean, you have Newark Broad Street going out, you have Newark Penn Station, you have the PATH train that goes, you can commute from Newark Penn Station into Manhattan in 18 minutes. So it's faster to get into Manhattan, into Penn Station from Newark than it is from parts of Brooklyn, the Bronx, the Queens. So Newark is very comparable to Jersey City and boroughs of New York City. New Jersey Performing Arts Center, NJ is there as well. That's this nice art theater there for theaters. You have the light rail through New Jersey, Newark, New Jersey as well. You have the boardwalk, Riverfront Park, and then the PATH train, of course, that goes right into Manhattan. So this opportunity here, we're going to be launching it officially in the next couple weeks. We're targeting a 3-year investment. 3 adjacent buildings just built. They're in the lease-up phase. They're being taken over by the lender. They're in receivership. That means they've hired a professional management company to manage the assets, and they're doing a pretty good job. The buildings are about 90% occupied. We're targeting 5% annual distributions to our investors starting Q1 of ownership. $100,000 minimum investment in the B class with a 7% preferred rate of return. $1 million minimum investment in the C class with an 8% preferred rate of return. And here you can see the difference in those classes. Class B, the lower investment class, the less attractive class, is a 17.5 IRR. Class C, more attractive fund to funds class, is a 19 IRR. All right, so you get a higher internal rate of return and a higher equity multiple, 1.58 for the lesser, 1.64 for the better. So that's the idea. That's why people invest in a fund of funds, get into the better share class. Target tax depreciation, 50% upon year one. That means you get a 50% paper loss upon investing. So $100 million investment, we would send back a $500,000 in tax depreciation in the year we buy the property through a cost segregation study. If you don't know what that is, you can go to our YouTube channel or my podcast, the Passive Cash Flow Podcast. Or you can talk to Donna. She probably knows what a cost segregation study
We
is.
had Yona on
Yeah,
here.
Yona. Oh, okay. So you know all about cost segs. All
Yeah,
right.
we know all about cost seg.
So we do the cost seg. We get the big tax write-off. We pass that down to our investors. 1031 exchange capital. Yes, we can accept 1031 exchange capital. If you have a 1031 exchange investor, we need to talk. All right, it's going to be you can't do it through the fund of funds. You got to do it through
The tenant in common.
Yeah, we do a tick. It's complicated. I'm not going to lie. It's a little complicated. If you have a 1031 exchange investor, we set up a call with me, you, and them. Let's get to talking. Let's see what their goals are. Let's see if they align with our investment goals. Let's see if the timelines align, right? Because the timelines have to make sense, most importantly. And let's work it out. We can work out a deal with you on the 1031 exchange investors. Retirement money, self-directed IRAs. That's a much easier strategy. A self-directed IRA can invest right into your fund of funds and boom, right into our fund. So that's just a normal investment. Okay. So we talked about all this stuff on the right here. Here's the timeline. Okay, November 2025, we plan to place the asset under contract. December 2025, LP investment commitment. All right, so we're moving quick on this. So you want to get in touch with TriVest quickly. Set up your fund with over the next 5 days. Work with us. We can set up a call with me as well. I'll put my call link in the chat when I'm done here. In January, we plan to complete our due diligence. By February, we have our loan commitment. By March, we closed. By April, we expect our first quarterly distribution. October 2027, 18 months later, we expect a stabilized asset. March 29, we expect to close, resell the asset. And that's big, that big liquidity event, right? That's the day everyone loves. You resell everything for a profit. So 3-year investment, distributions on a quarterly basis, starting Q1 of ownership. But we're moving quick here. We line up our investment commitments over the next 2 months. And that's it. I'm going to put my link in the chat here to schedule a call with me, Aaron Fragnito. I usually talk directly with people looking to do fund to funds. So you can bypass our client relations manager, Patrick, and you can connect directly with me, Aaron Fragnito. I'm going to put my Calendly link in the chat here, and we'll be able to connect here. Talk about your investment goals. Talk about your fund to fund goals. See if you are a fit to be a fund to fund manager. Talk about this current opportunity, And then we're off to the races. We're going to work together to help you build capital, raise capital, make those connections, close investments. And together, we're going to buy real estate and build our wealth through New Jersey real estate. Let's make it happen.
Awesome. Thank you for that. Yeah, it's a
Thank
great
you. Yes.
opportunity to be able to have a company that's willing to let you do a fund to fund with them. So that's awesome. So does anyone have questions about funds or fund of funds?
I have some questions.
Okay.
All right. And Mr. Fragnito, I heard you want a $50,000 commitment, but listening to you, the light went on. I have disposable income, and when the bills are paid, I have discretionary income. And I'm sitting here saying, okay, so do you know of, or Donna, do you know of, where can I invest? Where can I send the company money every month? So this way I build up my I don't have the drive or the energy or desire to be a fund manager, and I'm not going out and selling to raise funds. That's just who I am. Not no disrespect. That's just who I am. So
Sure.
I realized my best approach is to invest in some company where I can send them money every month. Is that you? Is it not you, Donna? Is it you? Is it where would it be best for me to put my money?
Yeah.
Sure. What amount generally would you think with that disposable income that you want to invest every month would amount to?
Well, it's probably negligible to what you need, but I mean, I I'm guessing where I'm looking at maybe for $300, $400, $500 every month. I could work it into my budget. Realistically, I could work it into my budget and go from there.
Yeah.
Yeah, I mean, what I would suggest with that, Donna, you can answer this as well. I know like Fundrise and sites like that allow you to invest, a small amount, and they have the kind of ongoing open-ended funds, right? Open-ended funds that you can invest a small amount in every month. You can also invest in REITs, publicly traded REITs that are completely liquid. Um, and or quite frankly, just mutual funds that ride the S&P 500. I mean, that's really the best place to kind of park that cash, let it build, and then as it grows, I mean, we do have a debt fund where the minimum investment is $30,000. So as it grows to that point, you can eventually invest in that. But for that amount, I think Fundrise or one of those like crowdfunding sites is your best bet. Um, and I know you can invest like $1,000 in some of those opportunities, even like 500, or a publicly traded REIT. It's completely liquid, which is nice. That would be my suggestion. Donna, what are your thoughts?
Yeah. Very similar to what Erin was suggesting. But if you could, save up a couple of months worth, you might have a different opportunity. Like
So let's say I save up like you say, and I have $1,000. Then what?
well, I know if you have $2,000 until the end of the year, you could invest in John's crowdfunding. But
Wait, wait.
John
Is John
Burley, right there. And
okay?
but it ends at the end of this year. But beyond
Wait,
that, I would have to think about it and get back to you.
and just for the record, no disrespect, Mr. Burley. Mr. Burley is different than the other guy who wanted $2,000.
No, same one.
So he was a guest speaker about 6 or 8 months ago, give or take.
Yeah, last year, right.
Okay. Okay. All right, cool. All right. Um, you said 2,000 by the end of the year.
Yeah, I mean, he prefers more, but if you have two, I think, John, you can make it work, right? Yeah,
I think he's muted out.
he's shaking his head. Yes, I saw it.
Okay. Can Mr. Burley, can you give me
I'll take it offline. But do you have Any other questions for Aaron?
No, no.
Okay,
Thank
because
Mr.
Javier.
Fragnito. Thank you. Like I said, I'm listening to you. The light went on. So
Hmm.
great. Thank you. Thank you very much. 2 thumbs up for that. I appreciate that.
No, I appreciate that, Stefan. Thank you so much for listening here. Glad you took in what I was saying, and that's important to know. I mean, like you're saying, it's not for everyone to go out and raise capital. It's a tough, John. It's like the pinnacle of my career, going out and raising capital. I've been a realtor, I've been in property management, I've been in the underwriting side. Raising capital is one of the hardest things to do in this business. And especially these days, the equity market is very competitive and saturated, and people are, inflation took a number on us. So there's a little less money in the coffers for a lot of individuals. So it's a tough equity market, but support of that track record and that drive. And but that's good stuff. And keep saving your money up, invest your money wisely. It sounds like what John does is really neat. So maybe I'll take a look at it myself.
Yeah.
All right. Thank you again.
Now Javier had the question next. Javier.
Yes, thank you so much, Donna. The guest for all the information, and not only giving information, but also showing his business in a very clear way. So I really appreciate that.
Mhm.
So my question, I have two questions. So the first question is, why you guys are so interested in New Jersey? I saw the last explanations of you can get closer to an area of New York than other places in New York, and Newark has all those buildings going on, like the next Jersey City or something like that. But I used to work there for almost a year around there. And I remember, probably I'm wrong, I saw so many ghettos around. So I wonder why you guys, instead of just going somewhere else, why why are you, I see that you are like interested in probably stay there for a long time in New Jersey, in New York.
New Jersey. Yeah.
Yeah, well,
Uh,
we buy. I know it's a little confusing because Newark is in New
New.
Jersey. Yeah, Newark, New Jersey. Yeah, so we
Yeah,
don't
yeah.
invest in New York. We do not invest in New York, right? In Manhattan and the boroughs, we do not invest in New York. It's terrible being a landlord in New York City, but Newark, New Jersey, is
Uh-huh.
a little easier to be a landlord. So the reason we invest in Newark or any North Jersey market is because there is an insatiable demand for housing. There is not enough housing here in northern New Jersey, and it's very hard to build housing. One of the benefits of investing in a blue state is that there's a lot of red tape. And that might not sound like an advantage, but here's the advantage of it. It's hard to build here. You look at markets like Houston, like Dallas, like Florida, even parts of the Southeast, Phoenix, they overbuilt these markets because it's easy to build in those markets. Those are red states. And listen, I'm all about getting the government out of our hair. I think less government's better government. But the fact is, New Jersey and being within an hour commute to Manhattan is one of the highest demand markets in the country. It's the most densely populated state in the country. We have great schools. We have great neighborhoods. Yes, Newark does not have great schools. Newark has some areas where I wouldn't go collect the rent after dark. It's definitely an inner city area that has a lot of challenges. But if you can find the right deals in the right locations, the rental demand is insatiable. The resale demand is insatiable. It's very, very strong. One of the hardest parts of our job is getting a good deal at a good price because there's so many people that want to buy real estate here in this market. There's a lot of wealth to go around as well, especially within an hour commute to Manhattan. So the fact that it's a red state, the fact that there's more restrictions on development, there's more of the government and the bureaucrats getting their hands in what we're doing, means that it's a security that the market won't be oversaturated, that buildings won't go up too fast, like you saw in Phoenix, like you saw in Texas, right? And that oversaturates a market. And then you have more inventory than you do supply. In New Jersey, you always have a limited amount of supply. You have more demand than supply, basic economics, right? When you have more demand than supply, prices go up, Rent goes up, property values go up, and that's what we see consistently here in North Jersey. Plus, rent control changes city to city, so you have to know how to navigate it. This building has no rent control because it's a new construction building. So that's a nice loophole in New Jersey. A new construction building, even in a tough rent control market like Newark is, this building in particular has no rent control. So you just have to understand how to navigate the red tape, how to navigate rent control, how to navigate these markets, and you could do very well in Newark, New Jersey, instead of following the headlines and jumping out to cities that all the other syndicators do. We like to offer a niche to our investors as well.
Awesome, awesome. That's amazing. Thank you for letting me know that. And the other question is like, I hope that it makes sense for you guys. So let's say that I have 5 people, friend, family that they can have like $150,000 every year.
Mhm.
And I want to bring them together to invest. So based on the fund of fund, on let's say let's say that's not happening right now for me, but let's say that I make more than $100,000 a year, and I want to invest every year for the tax sake and to have some passive income. Or maybe I have like, I don't know, 1 million and I have 5 million. So you think, I believe, based on what I saw here, that if with the fund of fund, starting with this company that you say that you pay 5,000 to start with, so it will be smarter if I take those 5 people I know and bring them to my fund of fund. We will make way more money if we just invest together as passive investors, of course, right?
Yep.
Yeah, that's the idea. I mean, it's not
Yep.
like way more money, but you'll make a little bit more money if you pool the capital together and invest in better share class. Here's the thing, Javier. You might say, well, why don't I just tell you, I'll introduce you to my cousin, I'll introduce you to my grandma, and you deal with it, and they'll invest with you, and then just throw me a few percentages of what they invest. Throw me a couple grand if they invest. So. And I'd love to do that, but the SEC actually restricts us from doing that if you're not a broker dealer. So the legal way to do this is for you to actually create a fund of funds, pool the capital together, and then write one big check into our fund, and then I'll write you back one check consistently every quarter for cash flow, and then one big one when we sell it, right? So, and then you can take your fees out of that fund, you can take your profit share out of that fund, and that's the legal way to do it. That's the right way to do it. I mean, the SEC does allow us to pay introduction fees, but they're not supposed to be based on how much the person invests or if they invest, right? We are allowed to pay, $100 for a name and number of someone or something like that, but then on our end, we're like, well, you could give us someone who's broke, and we're just being played, so like it doesn't make sense for us to really do that. And for you, it doesn't, if they invest 100 grand and we go, or 5 people invest 100 grand and you get $500, we raise 500 grand, well, you're leaving money on the table, because you could have done a fund of funds and made, 30,000, or actually in that case, like 75 grand or so, right? So the right way, the legal way for you to do it is to create a fund of funds and pull the capital together and invest with us. I would say, if you feel like you have those people in your network, make the list, make the A list, make the B list, take the time, do that. Then schedule a call with us. I gave you the link. It's in the chat. Click the link, schedule a call with me. Let's talk about your network. Let's talk about the people you know. Let's see if it's realistic. How much time do you have? Do you have 4 kids and 3 jobs? Well, maybe you don't have enough time for this, right? Are the people in your network truly at that level of wealth where they can write $100,000 check, or would it completely drain their savings and their IRA and everything they ever had? Then maybe that's a little much, right? But put that list together, start thinking about it, schedule the call, put the time in, let's talk. Maybe it makes sense for you, and quite frankly, if you could raise $500,000, I would get you into that better share class because I want you to get started. I want you to be successful, and we want to raise capital together. So if 1 million seems out of reach, but you're like, hey, you know what? I think I could raise $500,000. Then let's talk, because that's generally where people start. Quite frankly, most people don't start with raising $1 million. Most will start with raising like 500 to 750. And we make an exception. We get them into the better share class, and that's where it starts. And that's pretty realistic and actually easier than you might think, you know.
Oh,
That's
great.
awesome.
Thank you so
Thank
much.
you.
Yeah, thank
Great questions, Javier. We have one more question from John Burley, and we're kind of at time, but John, you're on mute. Oh, no, you're not on mute now. Okay.
Hey, thank you, Aaron. I enjoyed your presentation, learned a few things that were pertinent in my situation currently.
Great.
I put my question in the chat box, but I have a comment for you. How often you get back to the boat?
The the boat.
Steamboat. The reason I ask is my only child moved there 25 years ago, met his bride, and never came back to Texas.
Oh my gosh. I loved Steamboat Springs. I haven't been. I think I know. I went back once. Yeah. And when you're a ski instructor there, they give you Olympic level ski training. So it was phenomenal. I was in the best shape of my life. I was a great skier. I had so much fun and allowed me to figure out what I really wanted to do with my life and study it and learn it. But I love to ski. I lived in Vermont for 2 years in the Okemo Ski Resort, which does not compare to Steamboat Springs, let me tell you. So I don't blame your child for staying there, John. It's a beautiful area. You know, I'll tell you a quick story. When I was in Steamboat Springs, I met a guy and he was just skiing every day. I said, "Hey, what do you do, man? How are you able to just ski every day?" He said, "I started a construction company 10 years ago. My goal was to build it up, sell it, and move out to Steamboat Springs and live here and just ski every day." He's like, "That's what I did, and that's what I do now with my life." And I said, That's success to me." You know, I meet people that make $600,000 a year, but they work 80 hours a week and they're pulling their hair out. To me, success is being able to go to Steamboat Springs whenever the hell you want and just go skiing for a week. You know, now I'm not there yet. I'm working my butt off, but I'm going to get to a point in my career, my business where I can do that. And that's something I learned from Steamboat there.
That's awesome. Now, John's question was, which group is more difficult to break into, RIAs or family offices? Do you have an opinion on that?
Yes, I do actually. RIAs are really hard to break into in my experience. Here's why. RIAs are gatekeepers. They're hired guns. Their job is to protect their investors' capital, right? And they are like so afraid of risk. They're so afraid of making any type of mistake, you know, because they'll lose their job. They'll get their clients will fire them, you know, or they'll get sued, or, you know. So RIAs are really tough. They're basically more just focused on raising capital and doing like super safe investments. And if that means sacrificing returns their clients could potentially make, they're fine with that. They just want to make sure they don't lose money. They're all about having a good track record and raising more money. They're running a business. I don't blame them. So family offices, you know, it's their own money. You know, they're more willing to take calculated risks, and I'll build a relationship with the family office. Single family offices are the best. Okay, single family offices, because multi-family offices are a collection of smaller family offices, and they're usually managed by an RIA. And that RIA, again, is just the gatekeeper. And he's got a million different deals he's looking at, and he just wants to keep his job. And he wants to make sure he avoids risk at all costs. And that might mean not investing in alternatives or not doing anything that's like not a huge, like right down the fairway type of, you know, REIT or like $1 billion REIT. That's all they do. You know, they're not going to want you unless you're like a multi-billion-dollar REIT on CNBC, you know, that they'll never get blamed. They basically don't, if they lose money, they don't want to get blamed. They want to be able to say, listen, I invested in the biggest guy in the block with the, you know, the safest strategy that took no risks. And, you know, sorry we lost money, but I did it all right. You can't fire me. You can't sue me. Where a single family office, if you get to know them, you build a relationship with them, they're the patriarch. You know, they worked hard to build that business from the ground up, or they inherited a lot of wealth and they've learned how to build and manage their wealth properly. And they know that taking calculated risks with hungry entrepreneurs with a track record is how you multiply your wealth and how you get to the next level. Where an RIA is like just scared. They're like, oh, I don't want to get fired. I don't want to get sued. I'm not taking any risks, you know. And with single family, they'll be like, all right, I see what you're doing. I see your passion. I see your infrastructure. This is a good deal. You know, you did source something I'd never be able to get my hands on. I'll do a million, you know. And so we love single family offices. Yeah.
That's awesome. All right, we are definitely at time. But thank you so much, Aaron, for
Excellent,
for
excellent
being
presentation.
here. We encourage everyone to connect with us on our social media, on YouTube at Hook Up with Real Estate, on our Facebook groups page, also Hook Up with Real Estate. So thank you so much, Aaron, and everyone for joining, and for playing along with Hat Night. That's our October meeting all the time. Oh, Nigel's got his hat on too. That's awesome.
Nice. Nice. Good stuff.
I
Wait.
wasn't aware. Oh,
You didn't
nice.
read the email. It was
I
in there.
did. Okay. All right. Well, thanks for the
I love
invite.
that.
Love you
Nigel.
guys. Nice to meet you, Aaron. Gotta go.
Thank you.
Thank you.
Thanks, Donna. Thanks,
Thank
Kenneth.
you
Thank
again.
you.
Appreciate it.
All right.
Have a good
Have
Okay.
a good night.
See ya.
Bye-bye, everyone. Stop the recording.